to Zimbabwe. I think alternatives, generally, the way I would classify them is, the way to think about it is there's obviously the traded markets and the illiquid markets where you can't, pitch up at a stock exchange and buy the security you're trading or go through some sort of regulated or listed platform. So the way to think about this is there's a wide spectrum of alternative illiquid assets. We like to call them real assets, which is sort of the buzzword at the moment, and I'll explain that in a second. So broadly, you have everything from sort of private equity on the one side, in the one sense, and then sort of private debt. So for those of you who are familiar with the fixed income markets, you have a wide variety of listed debt instruments, from sort of investment grade corporate debt right through to high yield, and then you get into sort of the leveraged loan space. And then increasingly the direct lending space is because funds and institutions have found an opportunity to, post the global financial crisis, to come in where banks were not there before. And again, there's a lot of opportunities in those in Africa. And then the other two I would mention, you've already mentioned property, real estate is a key part of that, and infrastructure. So again, there's a wide spectrum of infrastructure assets, from transport infrastructure, real infrastructure, but broadly I would say private equity, private debt infrastructure, and real estate.
Thank you very much. I think that's it. Alternatives, real assets /101 there. David, could you probably share with us what role is alternatives playing? What has given rise to the need for alternatives from a developed market, and your outlook in terms of Africa?
Sure. I think I can definitely speak to one of the asset classes, which is your debt funds. Yeah. We have seen monumental growth in debt funds and their targeting of Africa as a viable space. Generally speaking, the banks are not actually well capitalized on the continent. So with the exception of, maybe I guess South Africa, Nigeria, maybe Kenya to some extent, you don't actually see club-funded deals and execution to the level that you generally see outside of Africa. And that's mostly because Africa's, the banking system's reserves rise and fall based on commodities, because we're primarily a commodity-based economy on the continent, right? So in a bad cycle, there's, kind of constraints on lending. Yep. In a good cycle, there's a lot of funds and people might be more willing to put out funds. And as Ron said, what's happening now is basically there's been a perfect storm. Private equity tried to come into Africa and has struggled to some extent because the normal cycles, of entry and exit have been actually difficult to stick to, because exits have become a problem for a lot of people that were invested and are now trying to sell off their assets. So there's a change now from the private equity story more to the debt side of things, because patient capital, putting cash to work in a way that looks more like a debt sort of product, like a bank, has become flavor of the month. So all of these different macroeconomic factors have actually meant that this huge space has opened up for debt funds to actually start participating in the African market. Yep. And I actually think within the next 10 to 20 years, debt funds will actually occupy more of the space than traditional banks in the market, and they'll continue to grow. And this is primarily in Africa, but it's also a global story.
But I mean, even as you talk about foreign African economies being resource-driven, to the extent that during times of low commodity prices, there's less foreign debt capital. How about the pension funds? We haven't seen, even if you look at the pension funds in Zim, there is very minuscule allocations toward private debt. Is it a lack of capital market depth, or is it just that they don't fit within how they want their funds to run?
I don't think historically it's been an asset class that the pension funds have looked at in the same way. And I mean, that's not only in Zimbabwe. Like Ron was saying, direct lending is a very, very new development, which is surprising because there's always been a gap for it.
Sure.
I think what the pension funds now are in a position to do is that they're sitting on lots of cash. They're cash rich right now. And they are very opportunely placed to make a play in a situation where there's no real competition because we're strapped for liquidity.
Yeah.
So I think that that's definitely somewhere that they can look to take advantage of an opportunity. But technically speaking, I mean, pension funds now, the real question is on liquidity again, because Zimbabwe is really just strapped. And it's all really caused by the US dollar.
Yeah.
We're not in a position where we can trade that currency freely enough because it's not our currency and we don't print. So you basically have a lot of cash circulating in a market, and to the extent it's not taken out, you know, you really have a finite amount of resources that's not really tradable.
Yeah, yeah. Would you say our problem is liquidity or cash? Or if you're talking about liquidity, is it in terms of the markets, buyer, seller?
I would say they are interlinked, right? Because cash is really the way you want to settle a transaction, ultimately, at the really basic level.
Yeah.
If you don't have cash, then FDI is hamstrung.
Yeah.
Because you can't actually settle any transaction. You can't repay or get a return from what you've put in.
Yeah.
And the liquidity issue, obviously, when you've got cash literally stopped. Right now you have queues all over Harare, all over everywhere in Zimbabwe looking for $50 a day to take out from an ATM machine. That is liquidity crisis, the definition of, right? So if you're in that position, then how can you actually expect to run a business, et cetera, et cetera? So a lot of our problems actually come back to currency and the availability of currency, because once that problem gets solved, we're actually in a very strong position because we trade US dollars and we get rid of currency risk, which is what the rest of Africa faces.
Interesting. Ron, just before I go to Raj, if you're looking at all this whole spectrum of alternatives from your private debt to the most illiquid infrastructure, which ones do you think stand a chance in an environment such as Zimbabwe?
Look, I think it's two simple things. First of all, before I answer that question, I think there is broadly a key answer to that, which is inflation, and I'll come back to that in a second. Because the answer to your question relates to how you understand Zimbabwe today and to what David is trying to explain, which is there a liquidity crisis or isn't there a liquidity crisis in Zimbabwe? Unfortunately, the reality is both answers are true. And what do I mean by that? So what is liquidity? So, you know, somebody could come here and tell you that there's actually 3 currencies operating in Zimbabwe, right? So understanding what's happening in Zimbabwe is very important. So number one, we are using the US dollar. As you know, that is an American currency. So for you to have an account, you know, the Fed has to know about it. So that is a foreign currency. So that is one currency used in Zimbabwe. So again, obviously you can go and use runs and so forth, but there's also bank balances. So if you have money in your bank, you can use a swipe card, you can go into Pick and Pay ATM and make a payment. There's also bond notes, right? And bond notes in principle have this sort of direct link to the US dollar, but if you go to certain folks, they're going to want 10%, 15%, I've heard even 20%, to get you physical, US dollars. So broadly, you kind of need to understand those moving parts. But what that tells you is, inflation is going up generally, so you need assets that have inflation sensitivity. So you're going to need assets that are going to appreciate as inflation goes up. Rent-based sort of property, assets that adjust income based on inflation. That's how I would understand.
I'm going to come back on that, because while we need assets that are hard, such as infrastructure, we're seeing a lot of these assets but housed in wrong vehicles. So we have the fixed income vehicle, and pension funds are saying, no, I'm expecting inflation to go up. You're going to hold the real asset, and I'm going to hold this fixed income security. That's not fair. But let me just move on to Raj, and just talk to us, Raj, about some of the activities that your company has been doing from alternatives. I know you've been involved in infrastructure, even to the extent of commercial real estate and roads, something that you're working on in Zim. Just talk to us of why that sector, what are you seeing that most of us are missing?
Yeah,
if
okay.
any?
Yeah, okay. So our company, Garuda Capital, we're involved in capital raising and project funding. And it's for people in Zimbabwe for largish projects in mining, in infrastructure, government. We have a tie-up with ZB Bank, for example. And essentially with cash movements into the country. So that's what we're trying to facilitate. Are we in Zimbabwe? We're not in Zimbabwe. Do we want to get into Zimbabwe? Yes. Then the question is, how would you want to get into the Zimbabwe financial markets and why? I think that's really the important questions. If I'm not in Zimbabwe now and nothing changes, there's no point in getting into Zimbabwe in any asset class that you're talking about. So whether it's property or real assets or financial assets or anything of the sorts. If everything's going to stay the same, none of the asset classes are going to be rewarding. And there's really nothing to talk about as far as that's concerned. But if something's going to change, then the question becomes relevant. How would you get into Zimbabwe, in what form, and why? And I can answer those questions now. So the biggest issue with respect to assets in Zimbabwe is pricing across the whole sector, whether you look at property or listed securities or fixed instruments, et cetera, et cetera. The pricing is nowhere near where it's going to be, in our view, if things had to fundamentally change in Zimbabwe. So what I'm saying is that the pricing is underinflated. So it's right at a minimum kind of level.
Would you say Zimbabweans are desperate now for cash? So this thing's at bargain prices.
It's horribly underpriced, waiting for something to happen. And we've seen this before many times in lots of parts of the world. And when it does happen, the changes are going to be massive, the appreciations are going to be huge, and people are going to wonder why, how, is it possible, is it really possible? And we've seen this happen in many different parts of the world. So if that kind of quantum change is going to happen, and we can go into the details just now, where would you want to be?
Yeah.
And I've heard a lot of people talking about property today, et cetera, and they have large portfolios in property, very large amounts of money, and we know some of these people and the players, et cetera. But you'll see probably a 50% to 100% appreciation very quickly. Then it comes down to fundamentals, supply and demand. If you have a property, you can sell it. If you don't have the property, you can't sell it. So it's physical supply and demand on the property side. But my view is that you're going to, on a re-rating of the country, you're going to have a huge pickup in the valuation of property and property-based assets. But that's not where I would necessarily want to play. My view would be that if you had a choice, you'd go into equities and listed equities. Because if the country is undervalued, everything's undervalued. And it's all related. It's all in a relationship. And on a equity, and you can pick anything which you want. You can maybe pick up the top 10 stocks on the Harare exchange, for example. And you'll find probably 300-400% kind of appreciation. These things do happen. It does happen. So if you were to be a Zimbabwean based overseas and you've got lots of dollars available, that's where you would want to go. What we call blue chip equities first, and then probably next, and then probably real hard assets probably below that if you're going to be more aggressive and less conservative.
It's actually interesting. We had this pension funds conference in May of this year.
And they've got plenty of liquidity, as we discussed. They Money coming out of the ears, noses, but there's nothing proper to invest in.
Exactly. But the point is that we had a boat cruise, sunset boat cruise, and one of the senior officials, board members for Airports Company of Zimbabwe, says to me, you see all these banks, Zambezi River banks, all of this land has been bought in the last 6 months. So it is stretching, and it says the money is not coming from here, the money is coming from South Africa. these are people that have got foresight. So they've been buying all that land on Zambezi River, stretching right from the Zambian side and the Zim side.
Yeah.
And before we know it, 3 months down the line, then we hear the headlines that because of the airport, hotel occupancies have shot up by 34%. So these are people that have got very sharp foresight. They've seen this happening, and there are lots of hotel developments that are happening there. Land prices are shooting up. But, I mean, as much as we are all here, we could have foreseen this when the new airport was being built. But I just want to go back again, backtrack and say, Ron, you raised a good point. You just touched on it. So real assets is a good thing, but what sort of vehicles would make foreign investors pour money into alternatives in Africa? Not only foreign investors, but even pension funds and retail.
Look, I think that's an ongoing story in the sense that, you know, the reality is you've got sort of two versions of realities in some aspects because, you know, you've just said there's people with liquidity, right? So I think there are people with liquidity depending on what your investment horizon is. Those people are going to put money to work.
Yeah.
I touched on this earlier on today. I think the stock exchange, the Zimbabwe Stock Exchange, has a lot of credibility. So to the extent that things can be listed there to begin with,
yeah,
to give people sort of, you know, transparency, institutional buying,
yeah,
that's a starting point. And I think
yeah,
we're already beginning to see that happen.
Sure.
You know, if you had invested in the stock exchange last year, you'd have lost on average 25%. This year, you're making at least 50, 60%.
Sure.
That tells you that 2 or 3 things are happening. There's not enough quality assets, but also more generally, there is inflation in the system,
yeah,
because of, you know, the sort of
yeah,
the currency disparities we've talked about. So I think it depends on what sort of investor you are. Clearly, for the pension funds you referred to, they're very much long-term in nature. So, you know, if they're going to get something to work, it's with that sort of view. But I think, you know, for the sort of short to medium-term investor, local market liquidity is a key point. And to the extent that some of these vehicles are listed, you know, I think you'll see the conversation starting to drift in that direction.
It's interesting to his point. We're working with this infrastructure project finance company, which is headquartered here. So we're trying to list a cash company infrastructure. And we're in the conversations with some of the banks and say, okay, could you house our escrow account? And some of the banks are like, oh yeah. It's like, it's $40 million. Like, oh yeah, but we've got enough liquidity. So it's a very interesting conversation that even the banks and the pension funds, it's just got so much money, and this money is looking for an asset to spend time in. Hey, talk to us about that.
I think it's quite interesting because part of my observations is that I think different structures in the country are not talking to each other. So you do have the pension funds with a lot of liquidity, and at the same time you've got different entities, whether public or private, looking for customers for product, for exports, right? And sometimes people take a very hard view on Zimbabwe and they decide, you know, we're not going to buy XYZ products, be it gold, be it platinum, whatever it is. And sometimes there are synergies in the pension fund, maybe just saying, well, I'll actually buy gold. Because as Ron said, they're long-term investors. If the pension fund were to buy gold and hold it and raise credit against it, then it solves a liquidity problem, and it also solves an offtake problem for those selling gold.
Yep.
So I think there's a lot of room in Zimbabwe for more collaboration between entities, and really a lot of it just means you have to think outside of the box.
Yep.
Because a lot of these asset classes and a lot of the players in those relevant industries have never spoken to each other before. And I think there's going to be a lot of cross-pollination because liquidity is the name of the game right now.
Yep.
So you follow liquidity, and liquidity finds its way into all kinds of odd places that it never would have visited before. So I think that there's a lot of upside, you know, especially in the mineral space for us, and also in the agricultural space. I mean, those are two of Zimbabwe's biggest plays. So if those are the biggest plays, and you're talking about solid, long-term investment, the pension funds are a natural place to go. So I think it is there has to be some more communication on those grounds.
If you had to fund mining companies or junior miners or medium-sized agriculture companies, what sort of instrument would you use? Is that direct lending with floating rates, or?
I mean, to be honest, I think
private equity.
Strangely enough, the more you dig into Zimbabwe's structures, it's actually very well structured. You've got aggregators in pretty much every sector. You've got, so for example, the MMCZ, Minerals Marketing Company of Zimbabwe, that's essentially also going out there and finding a market for products, right? For minerals, etc. So there are ways to actually aggregate and make the whole debt story a lot easier to deal with than actually talking about small-scale miners or small-scale whatever it is. That really is actually quite difficult administratively to manage. So if the system...
Isn't that the source of alpha?
True. I mean, it's a valid point, but I think in terms of trying to find an immediate solution, a lot of it is about just seeing a coherent, simple structure. Sometimes the simpler the better. And I'm still actually quite impressed by Nkosana's stories, because I think that's those very simple solutions to problems that the country is facing. And I think that's where you're actually going to create value, is in simplicity. Because getting more complicated, et cetera, means you always have to get around all sort of regulatory hurdles. You don't know if things have been done. You don't know clearly if you're in the black or the white of the law. Keep it simple. Keep it simple, and people understand it better. It's a lot easier to rate as creditworthy if people understand the product. And I think, like I said again, there is a lot of space, because we're looking at long-term investment cycles right now, for the pension funds to have discussions with a lot of different people that they wouldn't otherwise.
Raj, just to add that, in addition, if you could probably also talk to us about, because I'm aware you're almost acting as an intermediary between foreign capital, East Asia, coming to Africa. How are you securing your funds and capital when you invest in these investments in Africa?
Okay, so I'll come to
infrastructure.
I just wanted to comment first about the pension fund story. I think people need to be very clear. There's a lot of liquidity in the pension funds. It's caught up and it's stuck in there. Now, the problem that, and we're having this problem to a much, much bigger extent in South Africa. I mean, you have somebody like the PIC, for example. They're the largest asset manager on the continent. They've got over $1 trillion available, sitting there. Now, with all the pension funds, even the ones we spoke to in Harare when we were there, the issues are mandate issues. So they're allowed to invest in this, they're not allowed to invest in that, they're not allowed to invest in that. And when it comes to them, it's got to be in a particular format. So the long and the short answer of that is that money is not going to go anywhere. It's not actually going to be doing anything productive. It's going to be sitting there and looking at you, because these people who are administrators of those funds have mandate issues. So they can't put it where they want to, and they can't apply it where it probably could be most beneficial to the country. It could be most beneficial to the country, they lose their jobs. Crazy. Because they're not allowed to invest in certain asset classes unless it's got a certain track record or in a particular area, etc., etc. So that money is really sterilized money. It's going to go nowhere. If you want to access that money, the best trick is to be an industrialist, form a listed company, get your shares floated in the market, and then go to them and say, come in and subscribe for those shares.
There's governance.
There's governance. It meets all of those issues, and then you can absorb some of the money, and then something can start filtering through. Right now, the issue that they have is that there are not enough what they call investable securities for them to put money into. Okay, so it's sitting there, liquidity is there, but you can't access it because somebody's breaching the governance and the covenants and all that kind of stuff. So it's very, very problematic. The way to capitalize on that is to go ahead and pick up whatever listed stocks you have, or list new stocks, and then go and talk to them nicely and say, right, now we've got a class of shares, fund it. And you could be very, very wealthy for that, Ray. So you should consider that carefully.
So I learned about special purpose acquisition companies working with Raj on a certain project, and we're trying to do something with, as I said, another firm. But to talk to us, how can that work for Africa, for Zim? Specs, I mean, what is the opportunity? What can be made out of them?
Yeah, you know, it's very, very exciting, but the thing about good concepts is that it's always good when you read about it. So somebody needs to do it.
Yeah.
So if there's a few people who are courageous and who are quite innovative, they can go ahead and access that space. So, you know, where we play in as financial intermediaries. I was just explaining to Kosana, for example. We don't get actively into projects. That's our market definition, how we operate. But we can do that for clients. So if a client came to us and said, here we are, looking for $100 million, please go to where to find you. We'll go around the block in Harare and we'll find you the $100 million, but you pay us a fee for it.
Yeah.
But we can still access it. So that's the role of a financial intermediary and, you know, an intermediary company. So we access funds like internationally out of Asia, out of South Africa, you know, various places. So, but there's techniques and obviously issues to be overcome.
Yeah.
Money does find good projects. It comes out in the pricing. You have a good project with a good jockey leading it and chasing it, you will find the money and you offer the right price and the deal is moving. But if there's a mismatch in any of those particular areas, it's going nowhere and nowhere fast. So these are the challenges that we have.
Thanks for that. Ron, what sort of advice would you have for the intermediaries, the fund managers and the money managers in terms of creating the right appetite for developed nations, investors to put money into alternatives in Africa? It's a bit of a wordy.
In Africa, okay.
Because I suppose that's probably the role that you're playing with your company as well.
Well,
catalyzing investments.
Of course. I mean, you know, everything takes time. It's a long story. You know, I think, you know, I would echo what was said before. You know, Candice made a very good point about sort of the risk ranking. And, you know, what I liked about what she was highlighting is it 47 risk factors. Look, I think there is a reality and there is what perception. You know, Ken made a very good point. You know, Zimbabwe today, you walk into any household, they have got broadband, they've got Wi-Fi. This all is there. You look at the report today, Zimbabwe is 8th ranked in Africa in terms of internet connectivity. Right. I mean, I don't know how many people thought we were number 8, right? Zimbabwe has changed. So you need something that enables you to have information about the wider continent, and then, you know, you drive decisions from how you quantify the risks that you're taking. So definitely that's a key point, and obviously it's a key part of what we look at. I think in the long run, part of this story is echoing what has just been highlighted. How do you get, you know, institutions in the country who understand the country? You know, the point that Nkosana made, if individuals know where the gold is, you know, I'm sure institutions in that country, you know, are the best people to understand. You know, there's great examples in the power side of these small hydroelectric projects. You know, Zimbabwe is very good for hydroelectric. I've heard about another one in Nyanga, does about 8 megawatts or so. Again, these are projects that people have been able to come together and fund locally. You know, somebody said to me the other day, they you know, if they're able to put these things together, they're able to find the capital in country. So foreign investors, it's better for them to work with local investors in partnership, especially if they have the same investment horizon. So for a long-term pension fund sitting in California that manages 300 billion, and they want to put, you know, less than 1% in Africa, and that's still a big number. It's you know, it's less than 3 billion, but for us that's a big number. It's better if they're working with African pension funds in Africa in partnership. True. So I think that's, you know, that's the long-term story, and I think a combination of all of these things is going to help, and we certainly feel that that's an area that we would do more work in.
I really like Ron's dispassionate view. David, you want to add to that?
Yeah, I think, listen, it's an interesting space all over. What people don't seem to realize is Africa, like we said earlier, is not a country. It's 54 very, very different countries. And I mean, going down to the basics, when people are investing, a lot of it is what's the legal framework in the country that I'm investing in?
Yeah.
If the worst comes to worst, and I have to go to court, does it work?
Yeah.
Is there arbitration?
Yeah.
You know, how do I actually get my way out of a dispute?
Yeah.
And all of these things are the bedrock before you even look at any investments and any what I would say more safe investments. Yeah, and to the extent any of these issues are absent, that's when risk starts to ratchet up, because people are just thinking, well, if I put my cash to work, each dollar that I put to work is 60% at risk. If I go in an economy where I'm not actually sure, if worst comes to worst, I can get it out.
Yeah.
So I think for me, the key is really the frameworks. Work on the frameworks, the governance, the rule of law. In Zimbabwe, we're quite fortunate. I mean, we heard today that corruption is less of an issue than is perceived. We saw that the courts operate much better than is perceived. I mean, I was speaking to Lady Justice Dobbs, an ex-Supreme Court judge here. She does judicial training in Africa. She did a session with the chief justices of, I think, 13 different African countries, and she's visited each of them. And she said, by far and away, the Zimbabwean Supreme Court and Constitutional Court are the best run in the region. Now, this is not common knowledge, and it's not something that you can go and say, hand on heart to anyone, yeah, Zimbabwe is the best.
No,
People just won't believe you.
Right?
Because as far as they're concerned, the judiciary is politicized, this, et cetera, et cetera. And a lot of this is just perception. And really, I think the information part of this is key. You know, people like Justice Dobbs will write reports, and that will become more and more common knowledge about the way Zimbabwe works. And for any other country, very similarly, the more information comes to light, the easier it is for people to actually make informed decisions on the frameworks and how they work. So I think each of these sort of plays to each different asset class and makes it a little bit more easy to execute.
I'm just going to open the floor to 3-4 questions before. Yes, Troy?
So I wasn't here this morning, so maybe you can help me. Just key to find out is, what do the panelists think about Zimbabwe being overvalued? Okay, so just in terms of, is Zimbabwe, to what extent is the use of the dollar affect or affects it as an option? And then another very important question, since we're talking about risk, is I wonder what the panelists think is, to what extent do they think the Zimbabwe government could mitigate some of the risk through better communication? Yeah, those two elements.
Maybe I'll take the first one. You know, I think Ken has left, but what he said is value is a perception thing. You're right, there's two views. There are people who are going to tell you that Zimbabwe is overvalued because they have a view on where they think Zimbabwe is going. But when you go there and you speak to people, there are people who tell you that if they had, you know, $10 million today, they would invest it all in Zimbabwe because it's undervalued. So I think for me, I would come back to risk and say, what is your risk-adjusted return benchmark number, okay? If you're running a capital business and that number is 10, 15%, the amount of leverage you have to take in developed markets to achieve that, you can do with equity in Zimbabwe. So it comes back to you. The answer to that question is, what is your risk return objective? Now,
Straight equity, that is.
Sorry?
Straight equity.
Yes, straight equity. That's, thank you. Yes, straight equity.
8% on a savings account.
Yeah.
Exactly. You could, yeah, so that's right. You can get 8% in a savings account. Never mind equity, just, you know, a savings account, which they're starting to encourage more now. So I think you have to understand Zimbabwe in the context of where you are as an investment portfolio. Now, I think others are better positioned to comment on communication, but I think broadly what you're saying makes sense in that there is a perception, which is true, that people view the country risk in different ways. But I think a lot of it is you going into your sector and understanding the moving parts of that sector, because, you know, there are things that you know, that can only happen once you're on the ground and talking to people.
Yeah, right.
Yeah, I'd like to just comment about that. So I don't know why you would even suggest that Zimbabwe is overvalued or overpriced. I'm really intrigued by that. But anyway, I think it's got to do with what my colleague is saying over here. But you know, there's a simple thing. There's like 1.5 billion Indians wanting to invest out of India into Zimbabwe. And there's probably 2.5 trillion and 24 Chinese wanting to also come in and invest. So I don't think they're all getting it wrong. There must be a reason. And if you talk about being overpriced, when we had the 2008 global financial crisis, you'll remember what the Dow Jones was doing, what the home prices were doing, where everything else was doing. So when the Western world inflates assets and prices go up, it's good. When African countries' prices go up, it's bad, and it's called all kinds of things, inflation and this, that, and the other. Is it because we're living in a Eurocentric world or not? So I find these things very, very intriguing, except to say that there's a lot of untapped potential in Zimbabwe. The asset classes, to my mind, are all very cheap. I'm not saying value, I'm saying in aggregate. Okay, so you'll have to pick and choose in between. But you'll find that when things do evolve and when things do change, the prices that we are looking at now, which you might think are overpriced, will seem very cheap in relation to where it's going to be going. And that's what I think what we're talking about.
Yeah, I think I want to second that, because generally speaking, I mean, like I said, there's a stark absence of debt in the Zimbabwean market. So what you're actually seeing now, I mean, typically with most larger investments, you can get, what, 30 to 70?
There's no debt in Zimbabwe.
There's 30 to 70 in terms of equity debt ratios when you're looking at 100% investment, right? So really what you're seeing when you look at Zimbabwe is 30%. That's it. You're looking at 30% of possibility. And when you inject FDI, there's 70% headroom before you actually even look at the rest of the developments that can happen. So I think to say it's overvalued is, it doesn't make any sense to me, because really what you're talking about here is a country that's managed to do everything off the back of equity. And anyone will tell you that's not a smart way to manage cash, right? So I think that there's significant upside. On the communications part of it, that's a business that's a business idea. Someone should be there making ready communications about how Africa is working, because the truth is, let's say the government was more communicative. Would you believe them? Honestly. I mean, I'm not talking about Zimbabweans, I'm talking about the rest of the world. If there was a mouthpiece in the government that was telling you on a day-to-day basis about investments and about how well things are going and how you should invest in this, they probably wouldn't believe them, right? So really what it needs is someone in the private sector to be in a position where they're offering that kind of information in a digestible, reliable way that people can actually take, have confidence in. So as far as the information part of it, I mean, I take your point. Sometimes it does seem like a bit of a black box. But the truth is, if they were more open, it's going to be tough to say that, you'd believe everything that they said.
Interesting.
There's also a couple of things I wanted to add in terms of the practicalities. I sort of see where you're coming from in certain sectors. I think that there are parts of the property market where you're definitely right, because you're starting to see pressures on rentals and also some sort of government intervention in terms of rental levels. So there is sense in terms of what you're saying. But there's also sectors where there are now too many players. So you'd look for, let me give you two examples. The meat sector. So, 3 or 4 years ago, there were not a lot of players. But, 3 or 4 companies came into that sector and have got very good brands. And all of a sudden, you're seeing some of the listed companies enter into that market, and some of the more sort of well-run companies seek offshore financing to try and consolidate in that sector. So you're definitely right there. But in Zimbabwe, it's all about opportunity. A great example to complement that is water bottling. 3 or 4 years ago, that was not the popularity trend in Zimbabwe. But if you go into Zimbabwe right now, everybody's drinking water from a water bottle. And you have the same story here. You've got spring water from the mountains in Manicaland, Tanganda listed companies running that business. And you've got Coca-Cola have a similar brand to Dasani in Zim, which competes. But this is an industry that was not there 2 or 3 years ago, and millions have been poured into that industry today in Zimbabwe. So part of this is also where you're positioned in your portfolio.
Just one last thing very quickly. I watched a documentary where they said that to rent a house in Cameroon is $50 per room, and that to rent a similar house in Zambia is $50. So I'm just wondering whether, one, that's accurate, and two, what effect that has. Do you see what I'm saying? Just in terms of, not so much direct investors, but even for the economy itself in terms of making the economy competitive, because we want to be price competitive.
Yeah, I think the price competition is a difficult one, and that's just a function of currency, right? Because I would say generally, the domestic in Zim are paid 100 a month, maybe. That's a middle class person, low middle class in India, right? This is what we're dealing with because of currency issues. So by default, a lot of what is sold in Zimbabwe will be more expensive. I bought a bottle of coffee in Zimbabwe for $11, a pick and pay. But people are buying it. And it's directly related to currency, to the level of income and all of these things. This is something that will equalize over time, because the reality is we can't persist with a US dollar infinitely, right? Ad infinitum. It's not possible. So I think that kind of disparity will, it will equalize over time. But you can't get around it now, because you're pricing, a house in Zambia in dollars. And then that's a very, very different proposition when you're looking at their pricing in local currency. We can't compete on that level, but like I say, it's all relative.
I'll add also, just to support what has been said, particularly by Ron, that the markets in Zim are quite uneven. So you may find residential property to be expensively priced, but if you go to industrials, you might find that industrial property is much cheaper than Zambia. If you go to infrastructure, you might also find that assets in Zimbabwe are much cheaper than in Zambia. The equities market, I think by any measure, the equities market in Zim are now frothy. I think they are in dangerous ground. They are overvalued. They are probably, I think the market is probably plus 18 PE, actually performing more expensive than the Johannesburg Stock Exchange. And I think we've discussed that in the morning, that it's not because this is what people are saying is valid, but it's just a flight to safety. This is the most secure asset class that can price in inflation in the future. So I think it's also a source of business that if you can see those idiosyncratic phenomena, then you can actually take advantage of certain asset classes.
Sorry, my name is Karen Kumalo. Just a general question, really. As we're looking to expand on the asset classes we invest in or are available for investment in Zimbabwe, do we have the infrastructure and the policies in place to deal with the increasing regulations imposed by other countries in terms of regulations and stuff like that? How are we going to deal with that? Stuff like MiFID II or solvency and all the other policies that are making everybody else sweat worldwide?
So I'll just say one thing. So we were recently licensed by SEC, and one of the things that has been very onerous about SEC is that every week they are sending us emails. There is this policy, there is this thing about terrorists, and I'm like, I'm in Zimbabwe, but they have been very up to date with international regulation, policies, and restrictions, and they've been very efficient in terms of ensuring that every asset manager, every advisory firm is compliant. I don't know in terms of practical application, I'm not sure, but I'm sure you've got something to say.
Yes, I think broadly the answer to your question is yes, because even if we're not there, the conversations are on the way. You have to say yes. Our friends in South Africa have already implemented a sort of a Solvency II light version on the insurance side. I think whoever you talk to, they're going to say yes, but with a but after, and that but is with local configuration. Not everything that works here works in the same way in that market. And I go back to the point from this morning, a lot of our economy in Zimbabwe today is on the SME side. You'll be very surprised. Let's take a great example which was mentioned this morning, Old Mutual. A lot of their balance sheet, they're realigning real assets towards the SME side because that's where the market is. So everybody would tell you 90% of Zimbabweans are unemployed, but you go there, people are buying things. It's because a lot of the economy has moved to the informal side. So you're basically seeing a formalization of the informal sector, and with it, it means that the regulatory framework has to respond to that. That's why it's a yes caveated with local configuration.
Any other question?
Hi, my name is Tapiwa Mashingaidze. I have a question about just sort of the fundamental case for frontier market alternatives. So in sort of a traditional consideration of an allocation to alternatives, you're looking for, say, a disproportionate reward for taking on the illiquidity premium. Even if I went into straight equity markets, I would get the illiquidity premium in, say, in Zimbabwe. The other thing you're looking for is non-correlated assets. But if all assets are ultimately correlated in these situations to, say, commodities, what is the unique advantage that you get from going into a riskiest of the riskiest asset classes and the most illiquid of the illiquid asset classes? I'm just trying to get an understanding as to what the recommendation to the ultimate investor is for that.
It depends who the investor is. That's fundamentally the answer to your question. So if you're an insurance company, we've mentioned these examples, they have a business where they have to continue to pay out claims in an environment where, if in the Zimbabwean situation, because you mentioned Africa more generally, in Zimbabwe inflation may start going up as we've seen, but they need to maintain the core value of their capital. That's why real assets and all of these things are attractive to them, even if they're illiquid, because they're maintaining real value of their business going forward. For an individual investor, you can't necessarily put 40-50% of your portfolio into this market if you need that liquidity. But I think, as what was said before, if you're in diaspora, you've got 5,000-10,000, which you can park somewhere for a few years, then ultimately in the medium to long-term view, even if you're looking at the liquid part of the market in Zimbabwe, then it becomes attractive. So I think the asset allocation is driven, first of all, by your investor appetite across the spectrum of assets. I think the attraction for alternatives across the board, whether you're a household, a company, or an institution like a pension fund or insurance companies, to maintain real value. Because the problem with companies right now, which is why we had all these problems about non-performing loans, they hadn't reinvested in technology. And some of these companies have ended up going bankrupt because even if they were still continuing to operate, their infrastructure was not up to date. So it meant if you are outside the country and you brought new infrastructure, you were more competitive. So there are those sort of discrepancies in Zimbabwe.
Sorry, what I was saying there is you stated the case for alternatives, and that bit I understand. It's the extra step of the frontier market alternatives, that risk on risk. Say, for example, if I am an insurance company and capital preservation is of concern to me, there's an infinite world of infrastructure that I can potentially invest in without taking that extra frontier market risk, which is political, which is currency,
exactly.
which is
So this is an institution in Zimbabwe.
I see.
Yeah.
I was speaking from an outside.
Okay, from an out. Okay, so the reason why I say that is because from an outside perspective, it's easier if you had the access to partner with someone like an Old Mutual or someone like that who's looking to put their own capital, but maybe put 10, 20% of the allocation required for the project from outside Zimbabwe. So, it just depends on who you are. I think from your perspective, it's going to be a much lower allocation, but you should still allocate because of the long-term value appreciation. Because Zimbabwe overall is undervalued because of the perception risk.
Sorry, but then I guess we go from an allocation, as Rajan has pointed out, in the equity markets. If I took a long-term view, would I not just go into the liquid market? Because I'd still have that liquidity risk at the end of that infrastructure project. I can't move Kariba to New York in the way that, say, for example, maybe I can say exit TA Holdings or whatever other company on the ZSCI engagement. I'm just trying to understand from an outsider's perspective, does it ever make sense to go into frontier market?
I think the other thing that you can look at is exports, right? Because ultimately cash flow is offshore. It's not actually in your frontier market, right? So structuring transactions in a way so that you actually you've got direct recourse to someone who might actually be in the country sitting right next to you, because that's the ultimate kind of credit risk for your transaction, is smart, right? So a lot of it is structuring issues. So if you're thinking from the perspective of someone who does not want to take certain risks, then diligence is a must. You go and look at you do your property diligence, you get the kind of list of risks that you're willing to take and that you're willing not to take, and you get good advice, financial, legal, etc. And they, for the most part, might actually be able to let you take advantage of products and investments that you might not otherwise want to.
Can I try and answer the question that you asked? I think it's a very, very good question. And there was the first question and the second question. And then we had a bit of discussion on the panel. So I think there's a little bit of a cross purpose, but I'll try and answer it. The first one, I think what you're talking about is really pricing and valuation. And why would you do it in the frontier market? And then the response we had back was in terms of the source of funding, etc., and where the funding is coming from. So the funding would match an investment mandate, whether it be from a long-term pension fund, the tenor, the terms, the length of the investment, all comes into the correlation of the pricing. And there is some kind of effect on that in terms of who is chasing the assets. In other words, if there is a large institution chasing a particular security or a particular stock, then you'll have knock-on effects in terms of price, etc., etc. But we'll leave that out for the time being, and let's try and really address the question I think you're trying to ask, and why. Ray was talking about earlier in terms of the Zimbabwe markets being overpriced and the equity markets being very frothy and appreciating 80% and that kind of stuff. I think what people need to understand is that this valuation number which we have consists of a numerator and a denominator. In other words, you take your market price and you divide it by your earnings per share, and it'll give you a ratio. So that's generally called a price-earnings ratio. Now, it's a numerator and a denominator. What I think the markets are saying to us in a different way, and one needs to understand that the market prices that you see now are not today's price and what's happened today. It's what the market thinks is going to happen in 12 months or 18 months down the line. So there's something called a backwards price earnings and a forwards price earnings. So if one takes a ridiculous thing of 80% appreciation or whatever, what are the markets telling us? The markets are telling us that something's going to be happening to the real economy over the next 12 to 18 months. And it's pricing in and building in. It's anticipating what's going to be happening. We don't know when or why exactly and precisely, but that's what it's telling you. There could be liquidity issues, could be a build-up liquidity, there could be a lack of securities, tradability issues, etc., etc. So all these things come into it. But at the end of the day, you're going to find that your stock exchange ratios is what we call a leading indicator. So it's looking forward 12 to 18 to 24 months. And in that horizon, if something favorable is going to happen, then it's going to happen, and it's telling you the right things. And we would have misread the signals. So rather than being overpriced, it's actually fairly priced to better priced. If you take that kind of view, what the answer is, I don't know. I'm just putting it out there.
Okay, if I can just respond as well and do a rebuttal, because I think that's a discussion for another panel, right? Yeah. Forward earnings, I don't know, yeah. But I think you raised a very good point, and in one of the initial points with Ron, we were talking about the idea that the housing of these real assets, of these alternatives, is very important. And you highlighted the issue, the lack of liquidity, that why would you put money into Kariba and then only get an exit down the road without liquidity? And I think this is where we were raising the issue that now we are beginning to see vehicles that can list infrastructure assets to give institutional investors the added advantage of alpha and liquidity as well, and downside risk protection. I think there's one of those graphs, I think it's right this one, where we're saying that according to this research, in fact, global infrastructure has outperformed global equities over a 10-year period, outperformed bonds over a 10-year period. Now, this is global infrastructure. 99% of it is, maybe 90% of it is in the developed markets. We believe that with the infrastructure gap that has been protracted for a long time in Africa, the returns could very well reasonably be higher than those for developed markets infrastructure. So if you compound all those added advantages, that infrastructure in Africa will likely outperform infrastructure in the developed world. Infrastructure in Africa could very well be housed within an equity instrument that gives liquidity. And infrastructure in Africa has also that downside risk protection more than any other asset class. And you were asking, what if now all of these things are resource dependent? I beg to differ. I think there are many things, infrastructure assets, that are unhinged to resources such as water infrastructure. We're looking at deals in terms of water meters, bulk water facilities, energy as well. These are things that are tied to human consumption, which is very inelastic whether gold is doing well or not. So to that extent, I think there is merit in us considering infrastructure in Africa.
I think one important thing that we need to understand your question is where you're allocating from.
Yes.
Right? That's the information you also need to say. So is this a private equity that does Pan-Africa deals? Which is actually interesting because you've actually seen big private equity funds, some of them pull out of Africa, which speaks to David's point that if you're not going to get debt for these projects, you can't necessarily get those sort of level of returns. So that's a key part of the answer to your question. And then the other part which was missing, which is also very important, is to say, well, what sort of returns are you getting for what risk? We're all talking about liquidity, which you can address by listing on the stock exchange. But if you're in a development market and you're running a capital business, so think of it as private equity for simple terms, people will say, okay, my IRR target is 10%, I might stretch that to 15% with debt. How much of that is development risk? So you taking your equity to go into a completely greenfield project and putting together the building blocks for that asset. So you have to understand, if I just want market beta, maybe in this market I'm happy to take 5% returns, and if I want to increase that, maybe I put a bit of leverage. But if I want to start off from a higher base, then I'm taking other risks that are not on the table when we're just looking at purely a liquidity